Now, what else can we get out of this? Well, one thing that's interesting is now you can talk about, for example, how would this compare to a non-durable? What if we had a non-durable that had exactly the same time series of demand? What would happen in the non-durable market? Well, with this simple supply structure, what would happen is demand would go up, and we just go immediately to the steady state. So rents would jump up to here. Since price is equal to rent for a non-durable, price would jump up right to there. Investment would jump up right to here, and the stock would jump right up to here. The difference with this asset being durable is, number one, these prices are going to jump even more, particularly R. R is going to jump a lot. R and P are going to jump a lot more than they would have for the non-durable. And probably the most important fact is that I is going to jump a lot more. If this is a very durable asset, take this as an asset that has a delta equals 0.02, 50-year asset. Then in steady state, we're building about 2% of our asset base every year. If demand came in and we suddenly demanded 10% more of this asset, that's 5 years worth of production. We're going to have to jump I a lot to get up to the steady state. We may triple investment in response to a 10% increase in demand. We might go from building 100 units a year to building 300 units a year because demand went up 10%. Now, ultimately, we'll settle back down to 110 units a year because we're just going to go up by whatever the quantity goes up, or less actually, because we're not even going to get the full amount. But the idea is we could have a huge increase in I in the near term. That is, the investment's going to be much more volatile for these durable assets. This is what we macro people would call kind of the accelerator effect, right? That is, these durable assets are going to tend to have much more volatile production. So immediately we learn that why is it that investment's much more volatile than consumption over the business cycle? Well, one of the reasons is exactly this, that we're going to have a much bigger response to build any amount of stock. So if we wanted 10% of more everything, we wanted 10% more strawberries, 10% more houses, well, in the strawberry market, all we'd have to do is make 10% more strawberries and we're done. In the housing market, production is going to have to go up 100%, double, triple, whatever, for a number of years before we're going to be able to get 10% more housing, right? Because production is so small relative to the stock. On the other hand, relative to strawberries, consumption of this asset is much smoother because we don't get 10% more consumption until we get to the steady state. So even in that first year, even though maybe we're producing 300 the normal amount, our consumption is barely above where it used to be. It's going to take time to get up to that new steady state. So these assets are going to have very volatile production, but much less volatile consumption. Okay? Yeah. Purchases. The actual consumption of cars, how much people drive, the kind of the usage of these assets doesn't vary that much, right? Because you're focusing on purchases, which is an analog to what we call production in this model, right? That's like how many new cars people are buying. Just think about it like the housing market. In the housing market, the amount of houses being built in a given city varies a lot year to year. In a given small town, you might have zero production of new houses one year and a lot of production of new houses the next year. If you looked at how many houses people were living in, it's incredibly smooth. They might one year buy twice as much yogurt as they did the year before. But it's very hard to find a place where they had twice as many houses as they had the year before, right? Because the stock doesn't move that fast, right? Because you're consuming the stock. The use market is actually pretty smooth in terms of quantities, even though the production market is very volatile. And that's not a coincidence. They're tied together. The very reason the use market is so smooth is the same reason the production market is so volatile, because in order to move the use market much at all, you have to move the production market a lot. So the thing that durability is smoothing out consumption, but making production much more volatile. Now, even more volatile, if you thought about it, what if you had a durable asset used to produce the durable asset? Well, that thing is going to really be volatile, right? Because you say, look, demand for this durable asset went up. I'm going to triple production. Well, that's going to triple the demand for the inputs to production. But if that's itself a durable asset, tripling of the demand for use is going to do what to the demand for investment? It's going to be like 7,000%, right? And if, in fact, if you look at assets that are used to produce durable assets, that's the kind of demand you see. Those are very, very volatile markets. You know, if you look at, for example, you know, rail cars or the things used to produce rail cars. I mean, there's a hugely variable demand in those markets. And because they're tied into this like durable chain backwards. Okay? All right. Any questions that people have about this?